Welcome to the Gold Newsletter Podcast, your bank of knowledge of investment, economics, and geopolitics. Go to goldnewsletter.com for our publications and archives.
This is the Gold Newsletter Podcast. Fergus Hodgson, your host. Thank you for tuning in. If you've not already, be sure to subscribe. Hit that subscribe button. YouTube, BitChute, SoundCloud. We are glad to have you and love your feedback too. Leave a comment. We have, we say old friend, but Dana has been there since before the beginning, basically. And before Brian London, my often co-host, joined Jim Blanchard with Gold Newsletter, and I'm not sure what it was even called back then, back in the 80s, but we have Dana Samuelson, the founder of the American Gold Exchange, amergold.com, and a 12-year member of the board of the Professional Numismatists Guild. I hope I pronounced that correctly. Dana, I'm eager to chat with you today and learn what is going on with buying gold in this online era, and obviously in this bumpy, messy, somewhat post-COVID era. So what is going on? Welcome to the show, and what's the latest news?
Hi, Fergus. Well, it's great to be here with you. I always love chatting about what I love is precious metals, and we're a physical precious metals dealer out of Austin, Texas. What's been going on is, the last year, 15 months has been pretty hectic for us as precious metals dealers because demand pre-COVID was below normal, well below normal, because the economy was doing so well, unemployment was so low. We had a pro-business president, and despite the fact that our deficits were rising, they weren't rising to the degree they are now. And then all that, flipped on a dime in March of 2020 when COVID erupted, and demand for physical gold and silver just skyrocketed across the board. So we've had a very challenging environment for 15 months with more demand than there has been for most of the time available product, because the mints can't make enough to satisfy demand in the post-COVID environment. So premiums for most physical precious metals have been a little bit higher than normal. We've had some delayed deliveries. We saw the precious metals price spike to new highs for gold. Silver didn't reach a new high, but it got into the $30 range, which it hadn't seen for quite a while. Things are settling down now. We're in a corrective phase with the reopening of the U.S. economy, but that's creating a whole nother set of issues that we haven't ever seen in an economy like ours before, where something goes from closed to open and goes from no demand to extremely high demand. People have money to spend. We know that savings rates went up over the last year, and we've gone from a lot of goods that have been bought, creating higher inflation. Now we're transitioning some to more services as people get out and about more, but we've got a higher inflation than we've seen in 20, 30 years, and that's impacting metals prices. It's been a very interesting time to be in the precious metals business.
As you say, so much going on, and a lot of it is maybe conflicting, right? So you'll see pushes in one direction or the other. So as you said, high inflation, so we assume more people want to get metals, but then also the opening of the economy, maybe that means people have more confidence again. It gets confusing. And one area, please clarify for me, when demand rises, you say premiums rise, there are shortages. Why don't the prices just rise to clear off that demand?
Well, it's because it's not that there is not enough metal to go around. There's not enough fabricated metal to go around. The bottleneck with most of the mints is the blanks that the precious metals items are struck on. That's really where the rub is. So it's not like there isn't enough gold in the world or enough silver. There's just not enough of the form that we want it in right now. So especially in silver, 1 ounce of gold is equal to about 65 or 70 ounces of silver. So for a mint to make that same dollar value in silver, they've got to do 70 times the time and effort. So that's really where the rub has been, more in silver than in gold. And in COVID, these are tightly packed facilities where people are crunched in together. So if somebody gets sick, they've got to close the facility down, they've got to social distance. So the normal product manufacturing lines have been impaired too. Most mints are just sticking with their most basic products instead of some of the ancillary products that they would sell. So that's hampered the ability to produce. So we're getting back into some balance now with things but a bit quieter because there is more confidence that the U.S. economy is going to be doing better with the reopening.
Given that tremendously greater value density in gold, what attracts people to hold silver? I find this confusing.
Well, gold is money you can run with. It's real wealth that you can carry easily, right? You can hold $200,000 worth of gold. It's a little over 100 ounces at today's market value. You can hold it in your hand. It's the size of a paperback novel. In silver, you would need a truck to carry that much silver around with, or a wheelbarrow. It's a lot more cumbersome. But what silver is spending money in a crisis. Right? If you want to have money that you want to barter with, hard money, it's not going to be gold. It's going to be a silver. It's specifically a 1 ounce silver coin. It's about the best you can get. But also, it's the value ratio of gold to silver. With gold at all-time highs around $1,900, the last time gold was at that price, silver hit $50 an ounce. In this cycle, it's been under 30. So people see value in silver, better value in silver for their money than gold has for the same dollar amount. And I agree with that. As long as silver has room to play catch up to gold, which I think that it does by 10 to 20% at current market levels, I tell people if you want to spend money, spend 60-40 on silver to gold, because I think you'll do better as an investment with your silver a little bit than you will with your gold at these numbers. But gold has been leading because it is portable wealth.
Yeah, so basically you're saying that silver is more usable as a medium of exchange.
Correct.
Except for major purchases.
Right.
Right. Also, if you are a price speculator, you might think that silver has more upward room to move.
Yes, exactly. I think with gold at around, today it's around $1,760 an ounce. It's been up to 1,900, just a couple of weeks ago before the Fed talked about tapering a bit.
Talking about tapering. Yeah.
Yeah, 18 months from now, which of course is quite a long time in anybody's timeline.
Yeah.
I think silver should be $35 an ounce, not $26 an ounce in this environment at this gold price. That's where I think fair value is for silver, and it's just not there. So, and I think other people see it too. It's not. You don't have to be a rocket scientist to understand that.
Yeah, one bit I do not understand, though, is if you're holding the physical metals, obviously it's less liquid, right, than people are accustomed to.
The only liquidity issue is logistics. Okay, and actually gold and silver, physical gold and silver are among the most liquid things you can have. It's just you have to do a little movement of it to get it to where your buyer is if he's not right in your town.
That's what I mean, though. We live in this era, and this is one of the topics I wanted to get to today, and I'm sure you're grappling with this, where people want everything instantly, and they also want to do it from their fingertips. How is there a gravitation towards the vault programs as opposed to holding things personally, or not?
Well, our world is the physical world, so I can't really speak on some of the other alternatives because I don't live there and I don't understand what some of the motivation is. I will buy and sell gold and silver ETFs on occasion when I want to paper trade a market that I think is going to make a move in a short period of time. But most people that buy physical gold and silver do it because they want to have some hard money. They want to have money outside of the banking system rather than keeping it in the bank in dollars, right? Because precious metals do very well in an environment that we're in now where inflation is rising, yet interest rates are abnormally low and our debt is exploding. This is a very good environment to see precious metals prices rise, or actually the dollar drop against precious metals prices. So, people that want physical precious metals, they want real wealth they can put their hands on. That's really what it's about.
Yeah, Dana, we've had this maybe confusion over the past 6 or so months as we've seen inflation just continue to gradually rise over the past year or so. The demand for precious metals maybe hasn't risen as much as you would expect in such an environment.
No, it's not, because the Fed keeps saying the word transitory with regard to inflation. I think that has some people feeling a bit more complacent about it than they should. Okay, and we are going through a reopening that has the same kind of bottlenecks in it logistically that I described in precious metals manufacturing. We've seen lumber go from $475 on a futures contract to $1,600. It's back down to $900 now, but the big problem is getting the wood through the lumber mills and then getting it shipped, on trucks, because there's not enough trucks. There's not enough space in the lumber mill. So it's some of the inflationary forces we're going through are indeed transitory, but some of them are not. If wages are rising, which they are, they went up 3% this year so far, that's where inflation gets stickier. And it's a lot harder to take somebody's wage increase back from them once you give it to them than it is to see a commodity rise and fall. So we haven't had inflation for 20 years that's been meaningful. A lot of people don't know what to do in an inflationary environment. I think that's part of it. And most people don't react until it's a little too late. The public, how the public chases after markets more than they fundamentally buy into markets or sell markets that they should based on fundamentals. The public reacts emotionally. And when they decide inflation is a problem, it's going to be a big problem if that happens.
The Gold Newsletter is proudly sponsored by Inventa Capital Corporation, a venture capital advisory firm dedicated to the acquisition and development of assets in the natural resource sector. Today, Inventa is one of the premier mining groups with a first-rate portfolio of companies and a world-class team.
Hi, I'm Brian London, and I'm back this week with another one of our CEO interviews, where we interview one of the companies in the Inventa Capital Group, which is, of course, the sponsor of the Gold Newsletter podcast. This week, it's our pleasure to welcome back Charles Funk, the CEO of Heliostar Metals, HSTR, and that's on the Canadian Venture Exchange or the Toronto Venture Exchange, right?
Correct. See, on the TSXV, yes, and HSTXF and the OTCQX listing.
And Charles, so we were just talking off camera a second ago, and it seems to me that Heliostar has made a round trip in that a few weeks back, or in June, you announced a tremendous hit of 88 grams per ton, over 88 grams per ton gold, over 3 meters at the Apollo target on your Unga project in Southwest Alaska. And the share price soared over 50% or about 50% on that news. Tremendous hit. And unfortunately, you set the bar of expectations very high with that, because the next round of drill holes on the Apollo project were good, but not quite 88 grams per ton. I think you had the exit of one shareholder during that period on that news, and you kind of round trip back to where you were share price and market value was before that big hit. But at least you have that big hit now, and you know that kind of gold is in that target.
Yeah, I think two things. One is you see a nice example of the upside and downside of a tight share structure.
Right.
When it goes up strongly, and looks like we did have fairly chaotic selling. We don't know who it was, but it looks like someone exited a position, and that affected us equally on the downside. In terms of the project, the two results, the two press releases cumulatively have really advanced Apollo for us. We've got now 2 ore shoots that we've defined. Mm-hmm. As you said, the really high grade and some decent grade, slightly narrower hits in that shaft 2 area. And then at Sitka, multiple hits sort of between 5 and 15 grams. The best is about 10 meters at 9 grams. And so we've got 2 shoots to find. And our strategy was always come in with the RC. First of all, find the vein. If you remember, no one knew where the vein was.
Yeah.
Second, now get some understanding of the shoots, and then we can come back and drill deeper under those with the diamond drilling. When we come back, the idea was cover a lot of targets with the RC drilling and get to this level of knowledge.
So in effect, what you've done is you've expanded, you've gone through and not so much chased after what you're hitting, but pretty systematically explored the strike length, and now are still extending that strike length on the other side of the old Sitka mine. But the Apollo mine, shaft 1 and shaft 2 targets, you've gone through, you've identified the higher grade zones, and now you can go back and whenever the next program is and chase back those what you found through this round. In that you would naturally expect to have some high grade hits and some lower grade hits in that kind of a drilling program.
Oh, naturally, it's interesting. We had some analysts at site a couple of weeks ago when I was up there, and the feedback was that we haven't done a good enough job of showing how big this district is. And it's so underexplored for that size of district. So we could have easily done what people did in the past, and we could have gone back and drilled 20 meters at 20 gram hits at SH1 and did what's commonly done, sadly, in our industry. But this district deserves someone to open the blinds and show the full potential. And so we've gone to new areas like Apollo, like Aquila. And yes, you naturally get hits and misses. And as you said, our hits have been extremely high grade. In fact, in all the new targets we've drilled last year and this year, we've hit gold in every target, significant gold intercepts in every target that we've drilled. And so we step along strike. We don't know where those mineralization zones are going to be. So we do regularly miss. But what is important is over nearly a couple of 100 meters at Sitka, over about 100 to 150 meters at shaft 2, we've hit. And so we know now that that's where an ore shoot is, and we can chase that down deeper when we come back with diamond drilling. And so our strategy is to try and show the full potential of this district and not get bogged down in one little corner of it.
That's a great point, Charles, because when we first talked about this project, when you took it over, I related to you that I had been looking at it for a number of years, but previous operators just never had the kind of funding they needed to. And if they would have gotten that 88 gram per ton hit that you did, they would have instantly gone back to the market, raised some money, then gone back and done 10-meter step outs from that hit, and really not learned anything about the project. And in fact, this whole project, this whole area really is crying out for some kind of a systematic, well-funded exploration effort that can cover all of the targets, all of the ground, and find out where those sweet spots are, and then follow up on them. And it's important to know that that's not only is that exactly what you're doing right now. Apollo is obviously going to highlight as one of the targets, but you do have a number of other targets in this project.
Yeah, so we have more than half the drill program to come back. I think I said to you before offline that we rushed the first results because they could influence the field program.
Yeah.
And as soon as that systematically rushed those results, and as soon as we knew we weren't going to get them back, we went back to the normal process. So we're in a short window later into August for our next results. But that's I think the excitement when you get a virgin district like this is knowing that all of these areas that have outcropping gold mineralization, so many of them have hardly been touched. That's what we're so excited about on the project.
Yeah, and it's not quite that much of a virgin project because you have a resource here. Let's talk a little bit about what's already in the bank, as it were.
Yeah, so in that sense, you're right. It's got that 384,000 ounces at 13.8 grams. So the big tick, there's a great backstop in our valuation in that there's a robust high-grade resource. We're there, as we've talked about before, because we think it can be significantly bigger. And so this program that we're completing will have drilled more meters on Unger Island outside of that resource than its entire 135-year history. That's what I mean when I say almost virgin. Everyone's focused on that small resource that we're trying to grow and we think will grow, but there's a much, much bigger prize at Unger, and we're trying to unlock that potential.
Well, that resource doesn't need to get much larger to be economically viable on its own. It might even be at this size, and at those grades. And if it is economically viable, it far surpasses the value of your current market cap. So when we're talking about a backstop, it's pretty much in my view, you can be fairly confident that the value of the company is worth well more than what its current market value is, just on a resource basis. But if you also look at the exploration potential and how big it could be, then all bets are off.
Yeah, I think the risk reward, somewhat disappointingly, is very positive for new investors in that, you've got the short-term cycle in the typically gold prices pick up notably at the back end of the year. You've seen and you've written about that regularly. You can't help on the macro picture interpret the value of hard assets increasing with the amount of money printed. So the big picture, I think, is quite well set for the next few months. And then you overlay on that we've got really strong results. We've got the diamond drilling underneath the resource, all these new targets on a district that's seen such little exploration. And so I think you've got all these sort of levers combined with our tight share structure. But I think that's why Heliostar, I think, nicely fits as leverage to your gold exposure in your portfolio. And the next few months, I think there's a lot of tailwinds and very little downside with the valuation that we have.
So you've got about half of the drill results yet to come?
That's correct. Most remain, more than half remain outstanding, and they include the drilling at Aquila, where we made a discovery last year, the deeper drilling under the resource that's high grade and open. And then we've got all these other little targets that we managed to sneak a couple of holes into as well. So, lots of news flow to come. There'll be a hiatus for 2 to 3 weeks and then some consistent news flow. And then obviously we'll interpret them. And with the long field season, we're even looking at options to get back later this year.
Wonderful. So a much better company than you were before that big 88 or 80 gram per ton hit, yet trading at the same value right now, and lots more news to come. Charles, great update. Thank you for giving it to us, and we look forward to those new results coming out over the next few weeks.
As do we. Thanks, Brian.
Thank you, Charles.
Yeah, I hear you, because obviously people who grew up in Argentina, for example, they know get out of cash stat.
Right.
They just know that.
Right.
But Americans, as you said, they've been lulled into a false sense of security over the last couple of decades. But the truth is, if we know history, the modern US dollar regime it's very young. And it does not have a great deal of permanence to it at all. That only 50 years has it been around without a gold connection.
Right.
And only 100 years has the Federal Reserve even been in existence. So the notion that these are permanent fixtures is just wrong. And one of our other guests on this show, we've actually not released the episode. It'll come out, I think, in 2 weeks. I'm not sure. But we were discussing the challenge that in some ways there's inflation, but there's not yet the sense that the economy is faltering so much.
Faltering?
Faltering, that growth is slowing down. Because, of course, we're having this almost illusion of growth because it was such a hit before that anything will be growth compared to the COVID era.
Right, right.
Once that tapers, you might say, or slows down, we might see a lot of wind for change in terms of eagerness for precious metals again. Are you expecting this?
Yeah, I am actually, for a couple different reasons. Number one, everything looks really rosy right now. As you mentioned, the economy is doing great. We had 6.4% GDP in the first quarter, which is astronomical for what we've had the last 5 years, which is under 3% growth, absent 2020. The second quarter is going to come in probably just a little under 5% GDP. These are very strong numbers. People have been pent up. They're happy to get out. They just want COVID behind them. So they're not looking at markets. They're not looking at life the way they might normally look at things, because they want to get out and about and just get back to their lives. When an economy like ours is encumbered with the kind of debt that it is, at more than 100% of debt to GDP on an annual basis. There's a study that goes back 100 years. 9 out of 9 economies where the debt to GDP ratio was 100% or more for 5 years or longer, those economies don't grow at more than 3%, because money that goes to debt service would normally go to research and development or infrastructure spending, things that help grow the economy. Instead, the money shuffled to interest payments, which our interest payments in 2019 were $585 billion, one of the top line items on our budget, which is high. And if interest rates rise, that becomes a debt trap. So we've got to get through this phase, this I call it a reopening burst of economic activity, and see how things settle down, in another 3 months or 6 months. But I suspect that our growth, our GDP rather, economic growth, will revert to the mean, which the last 5 years was about 2.5%, which is substandard GDP. But that goes right back to, having too much debt. Our debt to GDP ratio now is 135%, and it's just going higher.
Yeah.
So I think we're going to enter into a period of what we call stagflation, where we have higher inflation, not necessarily 70s style inflation, but higher inflation and low growth, like Japan started in the 1990s and have been in for 30 years. I think that's our fate.
I tend to agree with you that this is just well known in the literature of economics that when debt to GDP gets over 100%, it just really, you don't even have to explain why. Just the evidence shows that growth is lower once that happens.
True.
And the fact is that the debt in the United States, we're only hearing about the official debt, right? The reported debt.
Right.
And we all know that there's just this mountain of unfunded liabilities which cannot be paid. And therefore, there's going to have to be some kind of reckoning in the next decade or so as to what to do with Social Security, because inflation is just going to continue rising until the federal government gets itself under control, which probably there's not the political will to do. So I don't really know what's going to happen with that. But it does not look good, and stagflation seems to be the likely outcome, where no one is willing to address inflation either by cutting spending or increasing interest rates, and this growing debt just makes a less competitive nation.
Right.
So why don't you tell us then, in the case of entering a stagflation era, which is probable or very likely in the United States, what are the key strategies for engaging with precious metals, right? Because there are all sorts of different ways to do it. You like the physical. You said sometimes you might get into ETFs, but physical. What about collectibles? What is the start here element or insight for people who are just not 40-year experts?
Well, if you're just getting started, I encourage everyone to have some physical precious metals. Okay, it's just a good way to have some of your assets set aside, especially in a more inflationary environment. We saw people like Paul Tudor Jones talking 2 weeks ago before the Fed announced that they were going to talk about tapering at some future meeting, saying that you can't ignore the inflation trade right now, which is owning commodities. And precious metals are one of the most sought after commodities in an environment like this. So I encourage people to get started with physical precious metals, stick with mainstream, competitively priced, widely traded items like 1 ounce US gold and silver eagles, or Canadian 1 ounce gold and silver maple leafs, or Austrian 1 ounce gold and silver Philharmonics. These are the top 3 physical gold and silver products in the United States today. They're the most widely traded, competitively priced, which gives you liquidity when you want to sell. If you buy some of the more esoteric items, you're going to have a little less liquidity. Especially, bars, we have to worry about some counterfeits in some of the bars because they're more easily replicated. We have a minor counterfeiting problem coming in out of China. If you're going to do business in the physical sector, do business with long-standing members in the community. Like myself, I've been in this market for 41 years now. I'm a Professional Numismatists Guild member, as you mentioned before. P&G members are the leading precious metals dealers in the country. And we abide by a code of ethics and binding arbitration if there's a dispute. So if you have a problem, it's better to have one with a P&G member but we self-police ourselves because we don't have problems.
Yeah,
right?
let me just comment about that, because in markets that are, let's say, inefficient and there's a great deal of room for bad actors, having a private professional guild actually makes a lot of sense. And I personally don't know a great deal about P&G, but it makes logical sense that in a market with so many bad actors and so much room for, as you said, counterfeiting and just people being ripped off or whatever, to have some private mechanism to resolve that. So I do think that's a smart way to go. So there are many rent seekers in industries, but I don't see this one as such an organization. Now, so your basic lesson was get physical, try to get the highly traded coins because they'll have lower markups and be more liquid. And what about dabbling in the collectibles? Is that foolish for anyone who's new to the game?
No, one of my areas of expertise is I'm a vintage U.S. gold coin and silver coin expert. In my early days in the working with Jim Blanchard, where Brian and I both met in the 80s, I was trained to be a vintage U.S. gold coin, pre-1933 U.S. gold coin expert appraiser. So there is room for those coins in a precious metals portfolio. They're scarcer than modern issues because they were made 100 years ago or longer, and what we have today is what survives. And some vintages were high, but survival rates are low. They can offer you leverage through scarcity, depending on where their premiums are today in their historical premium cycle over their gold content, that you're not going to get with modern bullion. And we have seen a period leading into 2020 where premiums for some of these vintage $20 and $10 gold pieces that we do a big volume in fell to their lowest level ever over intrinsic gold content. When you can get them that low in the cycle, they're a great buy. Now we've seen the premiums increase a bit, but they're still about 10-year averages or below. So there's some opportunity there. Like mining shares offer leverage. Your people understand mining shares, right?
What does drive the premium over just the metal content for these collectibles?
Well, the U.S. market is the biggest market in the world for collectibles. It just is. And people that like gold, some people like these collectibles because there's just fewer of them to go around. If there is ever a confiscation issue in the future, which I don't think will be an issue, but gold was confiscated in 1933 because there was a choice between a $20 gold coin or a $20 paper bill, and people didn't trust the paper back then. Now they don't know any better, and only about 5% of the public owns gold today anyway. So if they're going to come after the gold, that's going to be about number 20 on the list, and everything above that's going to be much hotter for whatever the problem is. But some people like the fact that they are non-confiscatable in that environment. We don't sell them that way as a number one feature and benefit. We sell them more on what's scarce, what has a low premium today, what has good opportunity for you that might be better than just bullion alone. And we do deal in rare coins, but these are not really rare coins. These are coins that have survivors of 10,000, 50,000, 200,000. So they're what I call bread and butter vintage gold coins. So there's liquidity there too as well. When you get to a really rare coin, you might only have 3 or 4 buyers for it in the whole country. The kind of coins that I like are more common and they're more widely traded, which goes back to liquidity again. If something happens to my company or me, and we're not around to buy back what we've sold, well, they're liquid anywhere else with reputable dealers like other P&G dealers.
What about returns over the long run? Let's say you're just looking to hold for a generation. Do the collectibles give better returns, or is it a wash?
Now, usually they will because they're not making any more of them, and there's more and more people to buy them. The pie just keeps getting bigger as a pool of buyers, while the available supply actually diminishes proportionally. Gold, if you look at gold since 2000, it's averaged about 8% annual gain every year. And then there are times when the collectibles will do better than that, and times when the collectibles will underperform a bit. It just depends on the cycle. We went through a really weak demand cycle in 2018 and 19, and premiums fell to the lowest levels I've ever seen. Like I said, they've reinflated a bit, but they're still relatively low compared to where they've been.
Okay. Dana, any other wisdom for people if we are going into a stagflation era of how to engage with precious metals as a hedge against that I've not extracted from you?
Well, sorry about that. It's a market close on my computer.
Yeah.
I do think that the purchasing power of the dollar is just going to decline over time from here, and perhaps aggressively because of our exploding debt. Right. So I think, it's going to be what do we say that? A tide that floats all boats that are gold, whether it's a gold bullion piece, a collectible piece, or a mining stock. I think gold's destined to go to 2,200 to 2,500, maybe even higher into the low 3,000s in this cycle. I think silver should be, over $50, probably closer towards 60 or 70 when all is said and done. We don't go into an environment that we're in now with artificially low interest rates and then rising inflation, which really our negative real yields are growing at the largest level we've ever seen them. And that's not reflected in the gold and silver prices yet. Why? Transitory inflation. Well, I don't think it'll be quite so transitory, but we're not pricing negative real yields into this either. And that's a subject, Brian London can talk about, very intensively.
This whole talk about it being transitory inflation, I find it such a weasel word, trying to deflect the fact that the Federal Reserve has failed to keep inflation under control, and they don't want to just admit it and accept the fact that they have little power to control it at this point. There's little room for them to raise rates. Anyway, so no, get in now while there's still low hanging fruit.
Yeah, gold is resetting higher. Every time it resets higher. And I think the bar is at 1,900. Once we get over that comfortably, we're not going to look back again under sub 1,900. I think anything under that, it's going to look cheap. And I think anything under $30 is going to look dirt cheap in silver. So you want to get in now rather than wait for the market to take another leg up. And your money will just buy less of this inflation hedge product.
You heard it here first, folks. Go to goldnewsletter.com/podcast for all the show notes. We'll link to Dana Samuelson, his various social media and his website. And I'll also put a link to Why Gold, Why Now by E.B. Tucker, a book which also promotes holding precious metals, especially coins and royalty companies. So don't miss out. Otherwise, Dana, I look forward to next time. And if you'll be at New Orleans later this year, I'd love to see you there too.
I wouldn't miss the New Orleans Investment Conference for anything. It's one of the best hard money conferences. It is the best hard money conference, bar none, in the entire world. Brian London has done an amazing job running that every year now for over 20 years. And I'm very proud of what he's accomplished. And I would love to buy you a drink or dinner while we're there, Fergus.
Mate, I'm looking forward to it. Folks, thanks for tuning in. If you haven't already, subscribe. We'll catch you next week. Cheers.